Hey, what's up guys? Welcome back to the channel. My name is Frank Mularcik and this is episode 23 of my Dow Analysis series. Today we'll be analyzing the 9th largest company in the Dow by market cap, which is Chevron Corporation, ticker symbol CVX. Hope you all enjoy. Chevron is a multinational energy company that is one of the successors of the Standard Oil Company. They have operations in over 180 countries and they participate in both upstream and downstream activities. So upstream basically means exploration, discovery, and extraction of crude oil and natural gas. And then downstream basically means refinement, processing, transportation of those same items, natural gas and crude oil. Chevron is also involved in developing and producing renewable fuels such as renewable natural gas, renewable diesel, sustainable aviation fuel, and renewable base oils and lubricants. That last part I think is pretty important because, there's a lot of petroleum products that are used, outside of energy and transportation, in industry with lots of oils and lubricants and other petroleum-based products like that. So I think it's important and very valuable that they are working on developing some of those products as well. For the second quarter of 2022, Chevron reported earnings on July 29th. They announced revenues of $68.8 billion, which is up over 80% from the second quarter of 2021. And similarly, net income saw a huge increase to $11.7 billion in the second quarter, which is compared to $3.1 billion in the second quarter of 2021. The second quarter overall was really big for Chevron, and they have really benefited from increased crude oil and natural gas prices around the world. But I think in the next few years, these record numbers are going to fall back down at least a little bit. And when I was doing my discounted cash flow calculation, which we'll discuss a little bit later, revenue and income estimates for the next few years are kind of slowing down just a little bit, but they're still, above where they were just a few years ago. So that's good to see. When we take a look at the balance sheet right here, the first thing that I do notice is the huge increase in cash to $12 billion in just the past 6 months. So this is comparing the end of 2021 to the end of June of 2022. So that's just 6 months. And combining that with a large increase in accounts receivable, we can see that current assets have grown to $51.2 billion and current liabilities are only at $39.1 billion, which gives Chevron a current ratio of 1.3, which is super awesome to see. And this means that Chevron will have no problem paying off their liabilities that are due within the next year. And I also wanted to take a look at, how the current ratio has trended over time. And I found this chart that shows Chevron's current ratio over the past 10 or 12 years. And we can see that they have had a current ratio above 1 for the vast majority of that time over the past 10 or 12 years. They just dipped below 1 for a quarter or two in 2017. So I think it's really good to see that they have a consistent record of a healthy current ratio, which indicates a healthy balance sheet. We can also look at total assets and total liabilities. Both of these figures went up a little bit in the last 6 months, but nothing really noteworthy. When we look at debt, though, is where it does start to get a little noteworthy, I think. We can see long-term debt is down drastically from $31 billion to $23 billion, but it's an even bigger increase when we look at net debt. So right now, net debt is only $14.2 billion compared to $25.7 billion just 6 months ago. So it looks like they have been putting a lot of these earnings to good use by paying down debt and increasing, cash, which I think is definitely a smart move and de-risks the business a little bit, given the macroeconomic uncertainty over the next few years. So I definitely think Chevron's balance sheet is actually pretty healthy right now. And I think the cash on hand, like I said, will be very valuable given, uncertainty in the next few years, in the macroeconomic environment, but also given the nature of Chevron's business and that industry is probably going to be subject to a lot of change in the next few years and decades. Chevron does pay a pretty strong dividend of about a 3.6% dividend yield, and right now their payout ratio is very healthy at 37.5%. So that payout ratio is pretty low, but when we look at historical earnings, we can see that Chevron has not really consistently earned above the $5.68 per share that they're paying out in dividends. They've not really earned that very consistently in earnings over the past 8 or 10 years. And they are in a volatile and cyclical industry that can really be affected a lot by political action, and so that's definitely a risk and something that could affect the dividend, and that could at some point drastically reduce their earnings and threaten the safety of the dividend. But right now I think the dividend is pretty safe. I don't think their earnings are going to decrease super quickly to a level that will make the dividend unsustainable, but they have so far been very consistent with actually growing that dividend. They have raised it for 34 consecutive years, and their 5-year dividend growth rate is on average about 5.3%, which I think is pretty healthy. It's definitely higher than a similar company like ExxonMobil, but it's not anything crazy, for sure. For a company like Chevron, I think that that 5% dividend growth rate is pretty solid, and if they can sustain that, I would be really happy with that. And I think that is fairly feasible, I think, over the next 5 or 10 years. So I do think the dividend is fairly safe, but it's not quite as safe as it might be just looking at that payout ratio, because I think their earnings have the ability, I guess, to change a lot very quickly, and that could be in the downwards direction, which would certainly not be good for their dividend. Starting now to look at valuation, the current PE ratio for Chevron is around 10, and as we can see, this is well below Chevron's average PE over the past 12 years or so, which has been around 14. So that's definitely a good sign to see. That might indicate they're a little bit undervalued. But a big reason for that lower PE right now is just the huge increase in earnings that Chevron has produced over the last few quarters, which we can see here. And, that's likely not super sustainable over the long term. And we can really see the cyclical nature of Chevron's business in this earnings chart right here. They've had some big ups and downs over the years, but if you are interested in investing in Chevron, you're going to have to be prepared for those cycles of ups and downs over time, and that's just something that's likely going to happen with Chevron. And when we look at their peers as well, Chevron is about average, so both the energy sector and the oil and gas industry, both of those have an average PE of around 10, so Chevron is pretty average compared to that, and nothing really notable to look at there, I guess. I also used a discounted cash flow model for Chevron, and with that I calculated a fair value for the stock of $198.43, which gives us a buy price of $178.59 with that 10% margin of safety that I like to put on there. So this is actually a fair bit higher than the current price of Chevron stock, which is around $155. So that indicates that Chevron could be a bit undervalued right now. I think a savvy investor might look at this discounted cash flow model and think that maybe it's being a bit too aggressive with revenue predictions, which will make cash flow predictions a little bit aggressive as well. But when I actually looked at analyst expectations, they are predicting a large increase in revenue for 2022, but they're also predicting a fairly large decrease in revenues for 2023 from 2022. So they are expecting, the business cycle to kind of crest the top there. And so we are getting some projection of the downside of that. And so I don't think that there's, too much aggressive predictions going on here. I think it's a pretty well-rounded discounted cash flow model, and I think that around $200 per share is on the higher side of what I would say is the fair value, but I don't think it's too outrageous. And firstly, looking at a 3-year chart right here, the big thing to notice is that they are way above pre-pandemic highs, and most of the price appreciation that we see in this chart here in Chevron stock has occurred pretty much since the beginning of 2022, and we can see that a little bit better when we zoom into the 1-year time frame here. We can see that explosive move happened at the end of February and beginning of March, but we can also see that they fell almost just as quickly in June. But since then, they have rebounded a little bit, and they actually bounced off of the $130 level, which acted as a little bit of a support there, which is interesting because that $130 level, which was kind of right around where they were before they had that explosive move at the beginning of the year. But another thing I see is that the 50 and 200-day moving averages are very close together right now, and the price is just kind of touching a little bit on the 50-day moving average, so it really could bounce up off of that level in the next few days or weeks. But I think that really is up to the overall market. If the overall market starts to fall quickly again, then I think Chevron will just go right with it, and there's not much that will happen surprisingly there. But I think if the market kind of trades flat or up, then Chevron could, bounce up a little bit off that 50-day moving average and continue up, at least in the short term, I think. For an oil company, I think Chevron is doing very well the past few years, and I think they're going to continue doing well, at least in the coming few years, and most likely in the long term. My personal opinion is that this whole electrification and move away from fossil fuels isn't really going to happen quite as fast as maybe experts or some politicians are saying. This is an advantage for Chevron because it gives them more time to make that transition to lower carbon energy. Their balance sheet is very strong at this point, and they have a lot of cash on hand and not very much debt, which will allow them to invest aggressively in some low carbon technologies and make that transition. The dividend is very strong as well, and they have a great history of dividend increases. So as long as they don't see some catastrophic collapses in their business, I think they have a pretty good chance of maintaining the dividend and growing it a little bit each year. Right now, for me, I'm not really interested in adding Chevron to my portfolio, and at this time, I don't own any energy companies, and I really am not interested in owning them, really for a variety of reasons. But I think it is still at a fairly attractive price if you are interested in owning energy companies or Chevron. But I would love to hear what you guys think of Chevron down in the comments below, and if you have any thoughts on the overall energy sector in terms of a long-term investment. As always, thanks for watching, and I'll see you all in the next one.